Excellent. Welcome back to the public. We've reached item 7 on the agenda. We're going to have a presentation on the triennial valuation results from our colleagues from Mercer's, Michelle and Jonathan. So I don't know which of you is going to take this lead on this one.
So this is a combined effort, but I'm going to kick off.
Over to you.
Thank you very much. So just going to ask my colleague Jonathan's going to share the slides with you. I appreciate you've got a report in the pack, you've got the funding strategy statement and a copy of the rates all in your meeting papers. What we propose to do is just talk through these slides which provide a summary of that information that's been shared with you. And as you'll be aware, we're approaching now the end of the valuation process. So valuation effective date 31st of March 2022, and the statutory deadline for getting that all completed and signed off by myself is the end of next week, so 1 year after the valuation effective date. So the purpose of today is to note the decisions that have been taken on the strategy, what that has meant in terms of outcomes of funding levels and contributions for the fund as a whole, but also for the individual employers that comprise the fund, and then just touch on the next steps to sign the valuation and the additional actions that are in play. So before we get into all that, I've got a recap slide that many of you might be familiar with, but I think it's always useful just to take a step back before we get into the valuation and have a bit of scene setting to kind of really think about what we're doing. And the obvious answer is, and the focus of the valuation is always on, what are the contributions coming out of the valuation? What do employers have to pay? And understandably, that is the focus for employers, particularly at the current time when, finances are so pressed with the cost of living crisis that we're all in. But the valuation itself, particularly from a fund perspective, is broader than that. It's an opportunity to review the risk management of the fund, and the funding strategy is a key part of that, but we don't do that in isolation of the other key elements of the risk strategy. In particular, we have regard to the investment strategy in terms of, for example, setting our assumptions on the investment returns we need from the assets to deliver the funding to the scheme, and also the employer affordability, because assumptions made around funding strategy will have implications for employer costs. And so we're always trying to balance the risk versus affordability for employers and balance the risk in particular that costs have to increase in the future. And so we're trying to make contributions stable across future generations. So that's kind of the overview of what what essentially we've been doing for the last 12 months in undertaking the valuation. If we turn over to the next section, then this just provides a summary of the key funding parameters, and then we go on to touch on the policies for the 2022 valuation. So on the first column, we've got 2019 and the approach taken then, and then we've got in the next column the 2022 valuation and comments on how it's changed. And the key points I wanted to draw out for you was firstly around the discount rate. So it's not a mistake. We've got that first on the table. That's probably the most important assumption that you make. It's a key driver for your prudence in your assumptions. And when we set the discount rate, what we're doing is we're saying how much future investment return we need the fund's assets to deliver in order that contributions can remain stable. So if the investment return from the assets is less than we've assumed, then contribution rates will have to increase in the future to make good that difference. So it's a really critical assumption. If we set it too low, then contributions are too high. If we set it too high, then we risk higher contributions in the future. And for the 2022 valuation, what we look to do is reduce the reliance on future returns in the discount rates. And the reason we did that was whilst the funding position at the valuation date looked good, and you'll see that when we come on to talk about results. We were at the brink of a change in economic outlook. We were already seeing inflation starting to peak. We were hearing stagflation and the increasing risk of stagflation, which has actually played out over last year. And therefore, to manage against the post-valuation effects, we reduced the discount rates slightly to protect employers from the risk of a step up in contributions in 2025. Couple of extra points around those discount rates. So just to recap, we look at discount rates or future investment returns in terms of the returns above inflation. So it's always relative to inflation. And the reason we do that is because scheme benefits increase in line with inflation. And so what we really need to make inroads into those costs is we need return above inflation. And so that's always our focus. We also look at discount rates slightly differently for benefits that have already been earned versus benefits that are being earned by active members remaining in pensionable service. And we do that because we've got a slightly different time horizon. So for benefits already being earned, that relates to benefits built up for active members, deferred members who aren't yet drawing their pension, and pensioners, so benefits already being paid out. So our time horizon is much shorter, and if we don't deliver the investment returns, then we've got a shorter period to make them up. And so we make a more prudent assumption. For future accrual, we've got a much longer time horizon before we need the money to pay the benefits, and so we can smooth out any volatility, or we've got more chance to smooth out volatility and costs over time, and so we can afford to be a little less prudent in that assumption, and that's helpful to employers in terms of the costs that they see coming through. So that's the, if you like, I spent the most time on that, and that's as I say, probably the most important assumption. Just a few quick comments on the other assumptions referenced here. Life expectancy, obviously coming out of COVID, a lot of focus on that. Main purpose of the life expectancy assumption is to estimate how long pensions will be paid for, although it does come into impact for other benefits too. And the assumption was set taking account of evidence through doing analysis of the fund and other LGPS funds, looking at actual experience, and also looking at future projections on and different scenarios on how life expectancy could evolve in the future. In terms of inflation, we looked at that in a much more detailed way for this valuation, again, because of what we were seeing going on in inflation at the time of doing the last valuation. So there's a lot of scrutiny in terms of how we assessed the long-term inflation assumption, but also we made a short-term allowance for the fact that we knew, even at March last year, we expected inflation to be a lot higher in 2022 than we'd seen in other years. So some of that was factored into the liabilities at the valuation date. And then the final comment here in relation to the other demographic assumptions. So we need a number of assumptions in terms of, how much tax-free cash members will elect to take at retirement, whether there are any ill health retirements, the potential for spouses or dependents benefits to be paid. And in line with approaches taken in other years, we carried out a full analysis of the Ealing Fund and of other LGPS funds to help inform that assumption. And small adjustments were made to those assumptions, but nothing that materially impacted the liabilities. It was more fine-tuning. So if we turn over in terms of the policies, so this summarises the key policies for 2022 valuation, some developments and some sort of remaining the status quo. The first one in terms of the average recovery period, so that's reduced by 3 years on as it's sort of a default approach for employers where there is a deficit. That is in line with what is expected of funds as part of the Government Actuary Department's review under Section 13. The aim is that deficits are recovered by a fixed date. So that means every time you do a valuation every 3 years, then the actual period for recovering that deficit has to come in by 3 years to maintain that fixed end date. However, what we've seen for this valuation is more employers in surplus, and that's created it's a good news story, but it's created a challenge because at the end of the day, as I say, at the valuation date, it was sort of a turning point in the economic outlook. We were on the end of a good period and starting to face the downturn. And so for employers in surplus, we put in 2 protections. One, a longer spread period for any contribution offsets to take allowance for that surplus. So surplus offsets were spread over a 12-year period rather than the shorter period for making good deficits. And also you'll see further down the table the reference to a surplus buffer, so that only surpluses above 110% funding level were used to reduce contributions. And again, that's to prevent sort of cliff edge changes in contributions for employers. You know, 1 minute they're in a surplus, then we spread the surplus, then they suddenly find out they're in a deficit the next valuation because the economy's turned and the outlook's poorer. So that provides some protection for employers and helps smooth their outcomes at future valuations. Other changes relate to an increase in administration expenses reflecting actual costs we've seen come through, and also future expectations. And in particular, we've noted there, you know, the extra work, you know, material extra work that will need to be done in relation to McCloud, and the dashboard requirements that Bridget and the team are sort of looking at and working on. We've also seen confirmation in terms of how funds need to allow for McCloud in the valuation this time, and that requirement to include it in the assessed liabilities. So the liabilities for this valuation do allow for McCloud, the impact of the McCloud remedy. At a whole fund level, that was less than 1%, so you know, not material. But individual employers, it will have varied. Some employers will see no impact, others could see, you know, several percentage point increase in liabilities as a result of that remedy. For this valuation, there was a new ill health insurance arrangement for those employers that weren't pooled already with the council for contributions. So we've called this an ill health captive. Basically, employers that aren't pooled will pay an insurance premium in effect to the fund as part of their ongoing contributions. And then if there's an ill health retirement, which can typically create some very large costs for employers, then the cost of that ill health retirement is met by the captive, whereas in the past it would need to have been met by the employer, and could mean material step-ups in contributions. And then the termination approach is something we have looked at in more detail for this valuation. So given, you know, market volatility and continued market volatility, we were concerned that there was a risk that, you know, employer terminating the fund on a fixed date would have their termination assessment done in a mechanistic way that perhaps wouldn't collect enough money from that employer leaving the fund just because market conditions had, you know, changed materially on that date. And so what we've done is we've incorporated more protection in your policies, in your termination assumptions, to allow the fund flexibility that if the market's going crazy, you know, I'm thinking in particular, for example, what went on with the LDI post the mini budget announcements last year. You know, if we see something like that and an employer terminating, you've got protection in your funding strategy to adjust the approach taken to ensure it still remains appropriate in the context of the employer leaving the fund and the extra risk the fund's taking on. And the final two there, prepayments and pooling, that's a continuation of the existing policies. So employers, as before, will have the option to prepay contributions for discount. And there are a number of academies that are pooled with the council for the purpose of their contributions, so they'll receive the same contributions as the council. So before I hand over to Jonathan to kind of say what all this means in terms of numbers, is there any questions on those first, the policies and parameters?
I'm scanning the room. I see no questions, so I think Blair one is the best strategy.
Thank you.
Thanks, Michelle. So the next few slides I'll talk over, essentially just bring everything that Michelle's mentioned together in terms of the policies and the parameters and how that actually plays out in terms of the valuation results for the Ealing Fund. So this slide here we've just summarized simply sort of the 2019 valuation outcomes next to the 2022 valuation outcomes for comparison. On this slide, as Michelle mentioned, sort of the key assumption for setting the sort of the liabilities and the balance sheet position is the discount rate, and also for setting the sort of the future service cost, what employers have to pay towards future benefit accrual. So we've shown here that sort of the two discount rates each valuation, and you can see again the 2022 discount rates are slightly lower than the 2019 ones for the reasons that Michelle's outlined. And one of the ways that we assess sort of the prudence within the basis and sort of the margins for sort of the future economic uncertainty is in sort of what's the chance of achieving those discount rates based on the current investment strategy. So you can see the percentages, the probability of attaining those discount rates has increased from 2019 to 2022. But part of that reasoning in increasing that probability is because of that uncertainty, actually needing to sort of take be a bit more certain about the returns at this time, given what we know post 31 March has come through in the economic outlook. What that actually means in practice, the funding level has increased overall from 91% at a whole fund level to 96% at 2022. So a good increase over the 3 years there. That translates into a reduction in the deficit from 124 million to 72 million pounds. In terms of the percentage future service rate, the change in assumptions and other matters, which I'll come on to show, has led to an increase in the average rate from 16.3% of pay to 18.5% of pay at this valuation. So a combination really coming through of an increased and an improved funding level, but also an increase in the future service rate emerging based on the parameters and assumptions set out. The next slide here just summarizes the main reasons why the funding position has changed over the period. And it's not just sort of the assumptions that we've talked about, but there are other matters there that drive the change in funding position. And so on the left-hand side, we've shown that in the balance sheet. And you can see there are some significant sort of pluses and minuses over the 3 years, which have served to impact on the funding level emerging. The biggest one by far and away is the investment performance of the fund's assets over the 3 years, which has been significantly greater than that expected. And that's even despite the sort of the pandemic and then sort of the volatility we saw in 2020. Coupled with that, employers have obviously paid in deficit contributions to the fund for those that were in deficit in 2019, again, serving to reduce the overall deficit. And whilst we know at the moment short-term inflation expectations are sort of high and significantly higher than previously, over the period 2019 to 2022, actual inflation was lower on average than expected, which served to, again, improve the balance sheet position. What we have done, though, as Michelle mentioned, we've given a bit more thought this time around to actually what the high short-term inflation, how that might play out in terms of the balance sheet. And we know in a couple of weeks' time, obviously the 10.1 pension increase will come through for LGPS members, those in receipt of benefits and those who have sort of left the fund and awaiting receipt, and also those currently accruing care benefits. And given that we knew that increase was coming through, we have sought to build in some extra protection to the balance sheet this time to sort of make allowance for that high increase coming through this year. It's not something we would have normally done from a valuation in terms of future pension increases, because typically speaking, that those future increases have been broadly in line with the long-term assumption. But this is a different time at the moment when we know there's the high short-term inflation, and that will have an impact on balance sheets going forward. So we're trying to build in some protection as part of this valuation to protect those employers with their contributions in the future. And the impact of that short-term inflation adjustment comes through in this analysis in the member movements and other factors towards the bottom of the chart. Just quickly before moving on to the future service, obviously we've talked about the changes in assumptions from the 2019 to 2022 in terms of the discount rate, which serves to sort of increase the liabilities and increase the deficit in isolation, but that has been offset by the changes to the life expectancy assumption and the other demographic assumptions that Michelle touched upon earlier. So sort of an offsetting factor there. Overall, though, when you take everything into account, as I've mentioned, the deficit has fallen quite considerably from 124 million at 2019 to 72 million at 2022. So a good improvement overall at the whole fund level in terms of the balance sheet position. The other main aspect of the valuation that we look at and the contribution outcomes is, of course, the percentage rate, which I've talked around. which has increased overall by about 2% of pay over the 3 years. And just on the right-hand side of this chart, or this slide here, we just set out sort of the main reasons for that change in the future service rate, namely the change in the discount rate, which drives up the cost by 1.4%, offset slightly by the changes to the life expectancy in those demographic assumptions we've talked about by 0.3. Michelle's touched upon sort of the need for the allowance for admin expenses to go up. So all employers that pay into the fund pay towards the cost of admin expenses, but from recent experience and future expectations, we've agreed to increase that allowance this time by 0.3% as well. And of course, the current calculations are based on current membership data at March 2022 and not March 2019. So emerging through the results is also the change in the membership profile of the members of the fund, the active members, in terms of they aged over the period. How has the average member contribution rate changed over that time, depending on sort of the pay profile, etc. The combination of those factors serves to increase the contribution rate by 0.8% as well. So taking all those factors into account, that they're the drivers for that overall whole fund percentage increase, as I discussed on the previous slide. So that's the whole fund sort of position summarized in those two slides. And the next two slides, we'll just talk a bit more around what it actually means in practice for the individual employers in the fund. So for those members of the panel who have been through the valuation process before, you'll obviously be very familiar with the fact that the LGPS is a multi-employer fund, and lots of different types of employers, a number of different employers participating in the fund. And as you'd expect, there are different outcomes for those employers that emerge through the valuation process. So this slide here, we just try to summarize really sort of in the two charts, how the funding levels for those employers in the fund, how they've emerged from the valuation process. And we've also plotted sort of the whole fund level there as well. So you can see how many sort of fall above and below that line. And as you'd expect, a wide range of outcomes there. As Michelle's mentioned, we're seeing a bigger number of employers now in a surplus position, so having paid off their deficit previously, but there still remains sort of over half the employers who are still in a deficit position and will need to pay additional contributions going forward to meet that deficit. In terms of the percentage rate, the future service rate on the chart to the right, again, as you'd expect, a wide range of outcomes here in terms of the employer base. Again, we've plotted that the whole fund level, 18.5% there for comparison purposes. So you can see sort of the range of those employers landing above and below the average whole fund. And why do the employer results differ from the whole fund? And as we set out here, there are a number of sort of key factors to sort of drive in why one employer's result will differ to another. Main one probably being where they started from 3 years ago. Were they in surplus 3 years ago? Were they in deficit 3 years ago? How's their membership profile changed over that period? Has the membership aged? In which case that will push up the future service rate, all else being equal. If they have a lot of retirements and ill health, etc. So all those factors get taken into account. Obviously, some employers, as I've said, have paid in deficit contributions over the period, so their deficit will have naturally reduced as a result of those payments. And certainly, as we've seen with the volatility in the markets over the 3 years, the timing of those payments also becomes important. If those contributions are paid in prior to a bounce back in markets, then obviously those employers will benefit more than other employers for that bounce back, given when they paid their contributions in. Membership experience, every employer is different and does have different experience in terms of retirees, new joiners, leavers, ill healths, pay growth. So there's a lot of different aspects of membership experience that we assess as part of this valuation, and then the outcomes of that will emerge in both the funding levels and also the future service rate that comes through. And finally, the assumptions that we apply. There are a couple of different assumptions that we apply when setting the outcomes for employers. One in particular is in relation to the percentage future service rate, where we apply a different methodology for those employers who are closed to new members in the fund. So typically contractors who are providing a service to another employer in the fund, there'll be that admission will be closed to new members. So naturally, that population will age over time compared to, say, the council, who is open to new members and has broadly a sort of a stable population over time. So there are slightly different assumptions applied in certain areas for different employers, again driving some of the sort of the variety of outcomes that we see here. And just before I pass back to Michelle, obviously, as part of the valuation process, we go through a consultation with all the employees in the fund, where we do issue their result schedules alongside the draft funding strategy statement and supporting information to enable the employees to sort of feed back to Bridget and the team as part of that process in terms of their own outcomes and any particular affordability sort of budgeting issues that may be raised as part of that process that will need further investigation perhaps, or further negotiation on their outcomes. And just to summarize here, really, what we've seen in totality emerging from the consultation and the individual employer outcomes. Over the next year, 23-24, we're expecting, based on the current valuation outcomes, total contributions to the fund of around £43 million. Now, under the old valuation plan, had we not done that, sort of carried out a new assessment, we'd have seen £42 million thereabouts that paid into the fund. So in totality, broadly stable outcomes in terms of the total pounds being paid into the fund. What is different this time around, though, is probably the split of that contribution between percentage rates for future service and also contributions towards any deficit payable by employers. Sort of the proportions between the two are sort of moving more towards now the percentage rate for employers. And we've seen that really because of lower deficits coming through from the increase in funding levels, and also the percentage rate increasing because of the changes in assumptions and the membership profile, and also payroll levels generally increasing over the period. So the biggest driver now of that £43 million is the percentage rate for employers. In valuations gone by, it would have been the deficit contribution element, which would probably be the biggest driver of the total contribution paid. For the council, we haven't included any direct numbers in the slides this evening, but based on the sort of the outcomes and the strategy parameters adopted, the council's been able to maintain its contribution rates in total to the fund, again following this valuation relative to what would have been paid under the previous valuation plan. And as Michelle's mentioned previously, and as we've seen on the individual outcomes chart, there are some employees in the fund who are now in a surplus position. There's 10 employees in total who are in a surplus funding position. But because of the introduction of the surplus buffer that we've talked around, which is designed to protect contribution outcomes for employers from one valuation to the next and not have volatility in those outcomes, there's only 2 employees in the fund who actually have a funding level above 110%. And so only 2 employers are actually seeing the benefit of that surplus in their contribution outcome at this valuation through a surplus offset. So I'll just pass back to Michelle now just to sort of summarise the final stages of the valuation process, what we're doing currently, and what also we'll be looking at going forwards.
Thanks, Jonathan. So as I mentioned at the start, we're nearly there, and now we're just at the process of the final steps to get us over the line, and then there are a few actions as well post-valuation that we'll be looking at. So this slide just summarises the kind of key additional things to note that are going on or steps that have been undertaken. And the first one right at the top of the list is the climate change scenario analysis. So new for the 2022 valuation, at the start of this year, GAD introduced a requirement for funds to undertake scenario analysis illustrating the impact of on the funding level of at least two climate change scenarios, and that needs to be reported on both in the funding strategy statement and also summarised in the valuation report. So that work is being undertaken currently, and the output of that will be added to the funding strategy statement as part of finalising that. Given the post-valuation data experience in the sense of the change in economic outlook that Jonathan and I both sort of referred to throughout this presentation, we have taken a closer look at how funding positions are monitored post-valuation date. Essentially, the traditional approach of reviewing discount rates every 3 years, and conditions remaining sufficiently stable to retain those discount rates between valuations, just wasn't going to wash in the extreme circumstances, particularly at the end of last year, when we saw material movements in gilt markets and in bond assets as well, which are sort of and so we've looked more closely at how the sort of discount rate can be applied in funding updates going forwards. And in particular, we've met with Bridget and the officers to discuss a monitoring approach that delivers a bit more insight into how the position's changing, whilst providing a sort of reasonably pragmatic approach to delivering that estimate over time. We've also got some loose ends to tie up on the funding strategy statement. So these are what we call a tidying up, mainly to reflect the climate change analysis that I gave reference to. Tidy up references to McLeod to reflect the latest status of the regulations which remain awaited, and the updates to the termination policy that I talked about at the start in terms of providing a more flexible approach for the fund under extreme circumstances, and also to reflect the approach I've sort of just mentioned around intervaluation funding monitoring, how we carry out that assessment, looking in a bit more detail. By the end of next week, I'll be required to sign off the valuation report. So that's the actuary's report on the work that's been done, and that will be made then publicly available. And then the final stage to do with the valuation actually happens after the statutory deadline, so after the 31st of March 2023, which is a requirement to provide data to the Government Actuary Department so that then they can undertake their review of all LGPS valuations in England and Wales at 31st of March 2022 to assess how the valuations have been delivered in terms of compliance with regulations and consistency between different approaches. And so we will be liaising with GAD on your behalf to talk about the results of that analysis before that's published. And so that, in a nutshell, concludes the valuation process. I would say before I finish, it's not set and forget. Funding moves daily, contribution rates don't move daily, but that monitoring stage will be important in terms of getting a good insight into the direction of travel for 2025. So that takes us to the end of the presentation. Probably a further opportunity for any questions if there are any.
Well, I can see Sukminder has indicated.
Yeah, thanks. I'm just a question on slide 11 where it says 2 of the employers have now met the requirements for surplus offsets to apply. What does that actually mean in practicality?
So, sorry, I've got an echo there. So basically the situation is where an employer's funding level is above 110%. Say there was an extra £10 million surplus funding above 110%, then that £10 million could be used to reduce the primary contribution rate going forwards, to basically run down the surplus over time, over a certain period. But the conditions for doing that, there's 2 conditions. One, that the funding level is 110%, not 100%. So what we don't want to do, for example, if an employer is only 101%, is run off that 1% only to find that the investment market's dropped 10%, and they would have been better off just retaining it, in the balance sheet as a buffer, and contributions then have to step back up because they're in deficit. So they've got to have achieved 110% funding level first and foremost. And number 2, that then surplus offset is spread over a 12-year period. So it's not all sort of offset over the 3 years to the next valuation cycle. That is spread over a longer period again to manage that risk of a sharp deviation in markets reversing the position.
So what that actually might mean in practice in terms of what the employer pays, if for example, their future service rate is 20% of pay, they might actually end up paying a net rate of, say, 18% of pay. So that's the 20% future service with some surplus offset to reduce that down as an example there.
Yeah, thank you for that, because obviously the alarm bells are ringing in terms of a pensions holiday, pensions payment holiday by employers, and we've been down that rocky road before. So just wanted to avoid that.
Yeah, completely understand.
Yeah, I mean, I think we discussed previously that the kind of almost random nature of the dates and the data that pertain on the date that's chosen, and had this valuation be done on the 30th of September rather than on the 31st of March, then we'd be looking at very different numbers, even though the world today would be exactly as it is today. So, it's fingers crossed and hold your breath as you approach the 31st, isn't it? And I mean, that GAD is a wonderful organisation, but I mean, I'm not sure I bless them for burdening us with, oi, why don't you do this as well at this stage in the process? But I certainly won't ask colleagues to comment on that. I mean, I'm always struck with the fact that we call it the local government pension scheme, when in fact it might be more accurate to call it the local government pension benefit framework, in which a lot of individual organisations pay lots of very different rates, because in real schemes, there is one rate, so it's a scheme only in the sense of what it commits people to pay. It always seems to me, and the kind of arbitrary nature of the demographic of your workforce and a range of other things, contribute so much to it. But I think we'll do it formally later in the agenda, but can I just pass to you on behalf of the panel our thanks for the work that you and your team have done in bringing this together in never easy circumstances, but probably trickier than usual this time round. So thank you very much to both of you and to everyone else behind the scenes.
Thank you.
Thank you.
Thank you very much. Moving us on to, and Jenny's had to wait longer than usual this evening, the Pension Fund Administration update. Jenny.
Yeah, hiya. Just trying to see why I look so blurry. Sorry about that.
I'm glad it's not just me.
Yeah.
Yeah.
She's blurred it forward.
Yeah, you blurred. Well, I think we'll acknowledge that you're there. So over there, brilliant.
There we go. That's a bit better. Okay. So yeah, the report's just about the performance, which isn't where we want it to be, and we know that, and the LPPA know that, and they're having quite a few issues with the new system. So the performance isn't looking at 95% where we would like it to be, but they have identified some bugs in the system that track the number of days it takes to complete a case. So they are trying to address these issues. So we're hoping that things will look a bit better going forward. I do know that January doesn't look good already. I think they're basically saying it's going to take until about September to get us back on track. So it's just a pre-warning that, yeah, the figures aren't going to look good for a few more months to come. And the other thing in the report is the new budget for 23-24, which does see quite a considerable increase, which we were a bit shocked at. So we have gone back to them and managed to get a reduction to it. I think a lot of their clients were saying this is too much. And I think their own board sort of came forward and said, yeah, we need to reduce the costs slightly. A lot of the costs are due to our increased membership, plus the costs of McLeod and the dashboard. And when you take those factors out of it, there's not much of an increase really. But yeah, if anyone's got any questions.
Okay, so if I understood from that first one, you're saying that the flaw in the software, new software, means that although we got a report about a decline in performance, that figure in itself may be wrong because the system isn't reporting accurately what is taking place.
Yeah, that's correct. It's not actually giving the true figure for the number of days it's taking them to complete a case. So they're allowed 5 days to complete a case, but they're losing 2 days automatically, is what they've discovered. It's just the system's just writing, it's writing 2 days off. So they could never make the target on some of the cases.
So there's kind of an asterisk attached to a lot of these figures. Are we hopeful that by the next report, I say this as somebody who used to work on major IT projects, so I know how things go. Are we hopeful? Have we been reassured that there'll be resolution in the near future?
Not in the next report, I don't believe. I don't think January, February or March will show it. I think it will start to come through by the time we see April, May and June. And they're hoping to have it all resolved. Some of it is reporting and some of it is their own issues, with staffing issues that they're having. It's very hard to recruit administrators. I think their turnover is 32% at the moment, staffing. So it's quite high. And it is to do with Project PACE as well, which was the transformation, and the final phase of that was only completed in December. So January's figures to me look pretty poor, but it is the knock-on effect of moving the other half of their business over.
Okay, thank you very much, Jenny. Let's see your hands. So I think if we can note the report and approve the budget. Agreed. Thank you very much. Thank you, Jenny, for your patience.
Okay, thanks.
Moves us on to item 9, the performance monitoring update for the quarter ending 31st of December. Bridget would like to introduce.
Okay, this is the usual quarterly update report. I will ask William to talk a little bit later about, although the fund has gone up. Philip, sorry, name dyslexia playing up there. Although the fund has gone up slightly, the performance of the fund managers has not been good, and Philip will be able to elaborate on that in a minute. But I thought before I go on, it's probably useful to just talk about what's happening in markets with the banks and what we're seeing in our portfolio. And we've communicated with the fund managers. So it all kicked off with a little known bank, Silicon Valley Bank, which not many big people had heard about. I certainly hadn't heard about them. And what's happened is they had invested in some bonds, and after 2008, the Dodd-Frank regulation came into force, but later on, they excluded some of the smaller banks from that. So they were pretty much doing what they wanted to do. And what this bank had done, they first of all have a concentrated client base. And also what they've done is try to get some additional revenue by investing quite a lot in bonds, long-term bonds. And so when they started to have more withdrawals, they had no option but to sell those bonds. When you sell them, when interest rates have gone up, you will be crystallizing a loss, at which point they were not so capitalized and needed to go to the markets to get additional funding. When they told the market they'd made this substantial loss, everyone was spooked. And so because they had a concentrated client base, people started phoning each other saying there's a problem, and there was a run on the bank. So that has caused problems in the banking sector. So what people have started to do is look at which other banks are in a similar situation. Although Credit Suisse was not in a similar situation, they've now identified Signature Bank and First Republic Bank. The other thing with the client base is a lot of them are not insured clients. So if your money is not insured, you panic a little bit more. I mean, lots of retail investors are actually insured by the government up to 85 £1,000, so you won't worry too much. But if you're not, you would be less sticky. So that has caused problems in the banking sector. And of course, Credit Suisse then came under a lot more scrutiny, mostly because one of their key investors, the Saudi bank, said, we're not giving you any more money. That again spooked markets. The Swiss central bank tried to support the bank. Markets were not hearing it. So at the weekend, they had to really work hard. Basically, I suppose, holding UBS by the neck, saying, you've got to work with us. Other banks were interested, but I think the Swiss wanted to keep it like a Swiss issue. But they've done something quite controversial in Switzerland, is that they've actually taken off the top level of bondholders, people who held a bond called additional tier 1 bonds. They've cleared them out, but kept the shareholders, kept some of the equity shareholders, which is very unusual. So what that's done is spook markets again. People started to worry about who's got AT1 bonds, and is this going to happen in other jurisdictions? The Bank of England have come to say, we will not do that. We will make sure we clear the equity stakeholders first before the bonds. And the ECB has also reassured markets. So what we've had to do is write to our bond managers to say, first of all, have you got exposure to Credit Suisse? And have you got exposure to the AT1 bonds? So yes, they have got a 0.69% exposure to Credit Suisse bonds, but not the AT1s. So they have not been, our investment is still there and not been written down, at least not to zero. So that's the position. We've also asked them to look at any other AT1s that they hold, and that there's no small print. That means that they can be written out. And apparently they've been looking at that, and they should be fine for that. Yeah, but it is an interesting time in markets. It's unprecedented, or well, maybe not. It's happened before, and it's happening again. A lot of the traders, like you say, who've not been around for more than 12 years are not used to this. So there's people who've been trading and are not used to the situation that's happening now. But we are monitoring the position. We've also written to all our private debt managers to see if they've got exposure to any of the banks. One of them said they had a credit line with one of the banks, but they've mostly drawn down on most of that. It's a credit line where they can take money out from, I think it was Signature Bank, in advance of drawing money back from us, but they've more or less drawn up on all those lines. So that's what it is. There's the key things to approve on this report are the additional 10 million for Permira, and all the other aspects of a noting. I'm happy to take any questions before we hand over to Philip. Get that right.
Thank you. I'm going to give Philip a chance. So I'm going to ask him a question, but I'm going to warm up by asking him a question I told him I would ask him before we started, which is referring to table 3 on page 56. Well, obviously, there are a lot of, I think, as Bridget was saying, funds gone up, but relative performance of our managers is down. There's a lot of red arrows compared with green ones. But I was taken by at the bottom of the table where it compares the historic record from the quarter, 12-month, 3-year, 5 years since inception. Normally, we have a bit of a mishmash of red and green arrows for the history. This quarter, we've got nothing but red arrows. And I was wondering whether I should ascribe any significance or import to this.
Thank you for that question. It's a great way to start the comment on the performance. So, as Bridget mentioned, the fund delivered a positive performance in Q4, given everything that has been going on is not a bad outcome. Looking though at the relative performance of the fund relative to the benchmarks that are defined for each of the managers and are used to assess their individual performance and contribution, generally that relative performance is poor. And as Councillor Donnelly says, it's poor at overall fund level, not just individual mandates, and it's poor over all the different time periods that you monitor that performance. There are two reasons for those things. In terms of it being poor at overall fund level, that's because a number of the underlying managers have underperformed their respective benchmarks all at once. It's poor over all time periods because one manager in particular has had a spectacularly poor performance in Q4 and in fact over the whole of 2022. And that manager is the London Civ Global Equity strategy. And the reason it's so poor is that the London Civ decided to allocate all the capital in that strategy, which is about 20% of your fund, and to put all that capital into the hands of one underlying manager, Baillie Gifford. Baillie Gifford is a manager which has a very concentrated portfolio and a very distinctive investment style, which means when the market conditions are favourable, it does extremely well, and when they're not, it can do extremely badly. And that's exactly what's happened during 2022. So what should and shouldn't we do about it? Well, we certainly shouldn't panic. That's the first thing to say. What we definitely should do, though, is make sure that we properly understand the reason for the underperformance and consider whether there is any action that we should take on any of these managers, or whether we should sit tight and give them a chance to recover the performance. In terms of understanding the underperformance, there are good reasons why each of the underlying managers that have underperformed have done so. It is really hard to figure those reasons out from reading the manager reports. And believe me, I've tried and done it. It is really, really hard. So what I was going to suggest is that the piece of work that we would have done later in the investment strategy review to look at the performance of all the managers in the portfolio over both the short term and the longer term, that we will bring that piece of work forward and present the results back to you at the July panel. And we will explain in much, much clearer terms the reason why relative performance for those managers was so poor in 2022, and whether that performance is something to be worried about, and if it is, what actions the fund should take to address the performance going forward. Already, I can see certain areas where I think there is action that we could take, like the London Civ product, splitting the capital between two underlying managers, be a very sensible action to take. With some of the other managers, I don't think there is any action we should take at all, because the relative performance we're seeing is down to currency fluctuations that will fluctuate as they do, and we should instead really be focused on the long-term performance. So that was my suggestion to you, so that we can all better understand the reasons for that poor relative performance, and feel comfortable that we're taking appropriate, considered action where necessary. Happy to take any questions though on any of the blobs of red ink.
Thank you very much. This panel, of course, abhors panic, but I think I think we would welcome the kind of accelerated review that you were talking about there. I know perhaps it's not. I don't think it's mentioned anywhere in the papers, but Bridget, Emma Hill, and I met with Dean, the new chief executive of the London Civ, and I think we were impressed by the energy and a kind of focus on perhaps making some changes to certain aspects of how the Civ operates. We shall see how that pans out. An organisation of 32 boroughs plus the City of London is not a gainly ship to turn around. So did you have a question? I was trying to remember from before.
If I can remember it, it was to Bridget actually, because it's just out of interest, where we have got some money in one of these banks. I don't know how much it is, but what have we given any indication or instruction of what to do with it? Are we pulling out of that bank, or is it going elsewhere, or what?
So we have no exposure to any of the US banks, and I outlined that we've got a 0.69% bond manager investments. We're still waiting for the equities managers to come back, but we've got the 0.69%, but it's not been wiped out. Not yet, anyway. Well, yes, we are.
We're assessing the situation.
It's a very sort of localized question, but on 5.8 Loughborough's, it says that it's declined in value by -26% because of a prime industrial estate in Greenford. Do we know why that's declined? Does anyone have any idea, or is it just a fact?
So I think that's a good example of the noise that you read in manager reports singling out an individual asset. I don't know what's happened to that particular asset, but it's probably a red herring, frankly. The issue with both Loughborough and I'm going to get it the wrong way around. It's Loughborough and Standard Life, is that both of those managers were on the wrong side of what has happened in industrial property in the last 3 to 6 months. Industrial property has had a tremendously good run. The assets have increased dramatically in value. Some managers, including those two, were significantly overweight to that sector. And then towards the end of last year, capital values in the industrial sector started to fall very, very quickly. And both managers got caught on the wrong side of that development.
Thank you.
I'm sure they're not trying to tell us that it's our fault for having Greenford, a marvellous place of which we very much approve. Paul.
Yes, thank you. It's just to follow on that theme of property, because looking at it all uniformly, there's a decline, and it's about 10% of the value of the fund, I think. So, I mean, if you're going into reviewing some of the details for the next meeting, like, does this following any trends, or is it just a market blip? You know, what does it signify for the future, or where that property trend is going? And if it's industrial, or is it other commercial properties or the retail, whatever, just trying to find out what's going on.
So well before we saw these performance numbers, in fact, almost a year ago when we were scoping the strategy review, we identified property as one area that we should focus on, and consider whether the way in which the fund implements that allocation is optimal, given the additional solutions that you have available now through the SIV. So the reason for proposing that is that we think that the way in which you implement property could be improved without materially increasing the governance burden on the fund, and that will definitely be part of the recommendations later in the year. That said, property is having yet again another tough run, partly on falling capital values, particularly in industrial and still to some extent in retail. So big headwind there. For sure, and property is also starting to see the impact of the decline in economic activity. So rental growth projections are falling, which absolutely you'd expect when the economy slows down. Tenants can't afford to pay more in rent, so landlords can't collect as much rent. And that flows through to the value of property assets. Have we seen the end of that? The property industry thinks yes. We don't agree. We think there's a bit more bad news to come out in property. Probably not on so much on the capital values, more on the rental income side. But we've probably seen the worst in those figures in the second half of last year. Bit more bad news to come, but we're probably through the worst.
Alan?
Thank you. Only to endorse the let's not panic mantra, really. I think that's, we should remember that obviously we are ultimately long-term investors. You know, we're investing forever as a fund, and I guess the assets that are performing least well are the ones that are volatile in nature. My question was actually very simple, which was when we since inception, could you just remind me, as someone relatively new, what that date is? Because obviously I can understand 3 and 5 years ago, but what do we understand to mean by since inception?
It's a combination of all the managers since inception. So they've all started at different times. So the oldest manager was 2007, which is the Royal London bonds. And then all the other managers have come in. So somehow they consolidate it and work out a since inception for everything. No, but I would say the oldest fund manager in this portfolio is 2007.
Which sounds like an incredibly complicated way of doing it, but it is a fair thing to do, because what it's saying is that the performance figures that you see on there are as close a representation as they can be of the managers that you've got working for you at the moment. Whereas if you did it a different way, you would have in your figures, you would have performance, good or bad, contributed by managers that are long since gone. So I think that's why they're doing it now.
Thank you very much. I don't see any other hands. So before I move the panel to adopt the recommendations, I just want to draw attention to 1.17 at 13.3, referencing the pension fund annual general meeting, which I had the privilege of attending and chairing. Thank you to Philip for being one of our excellent panel of speakers. It was a real excellent range of contribution, and kind of place on record on behalf of the panel our thanks to Bridget and everyone who was involved in putting that together. It was a very, very successful morning. I enjoyed it very much. And Bridget, I understand perhaps you could update panel on the feedback.
I mean, the feedback was very good. I think everyone certainly enjoyed the sessions. They found them useful. They found the chairing good. And yes, it was a good session. The room was a little bit cold, I would say. That was, yes.
Those watching online, you know, the irony of being in a slightly cold room, talking about a slightly cold room, isn't lost on those. Isn't lost on those. Victoria Hall was difficult to heat that time of the morning, but I think people enjoyed it nonetheless. So, having said that, if I can draw your attention to recommendations 1.1 to 1.20, can I ask if they are agreed? Great. Thank you very much. Moves us on to an item familiar to us from a few minutes ago, the 2020 Pension Fund Triennial Valuation. We've had the report. Is there more that needs to be said, Bridget, before we consider the recommendations?
Chair, sorry to be a nuisance, but should we have separately approved 1.10, the extra money?
Well, I asked for the recommendations to be approved. One of those recommendations is to agree. So, but I think Bridget did highlight that specifically, but I'm sure if colleagues are aware, the £10 million investment, it's a fair thing. We don't invest money blindly. So thank you for reminding us, Yvonne. So yeah, back to the valuation. I mean,
yeah, nothing to add except that we approve or talk about the recommendations, which is and delegate authority to finalize.
So again, noting our thanks to our Mercer's colleagues for all the work that they've done, and the fact that the fish is almost landed on the bank. If I can ask that the recommendations 1.1 to 1.4 are noted.
Agreed.
Thank you very much. Agreed. Moving us on to item 11, the pension fund budgetary estimate and work plan.
All right. Unless there's any questions on this report, this is the budget. Jenny already highlighted about the increase in the administration budget. Otherwise, there's nothing key to point out.
Any question? No. Noted. Thank you. And noted and agreed. I think 1.4. The date of next meeting, I think we've identified, will not be Sunday, the 23rd of July, but Keith will be
5th of July.
The 5th of July. Yeah. The 5th of July. So one for your next year's diaries, which I think is pretty much available now anyway. So I'd like to thank Jonathan. Michelle, I think, is still with us. So thank you for staying on in case we'd had any further questions. I think we lost Councillor Busuttil at some point during the meeting, but we can note that in the minute. And apart from that, thanks to everybody for your attendance, your contributions, and your support. And I think that is us. Thank you very much. Good night.